Hello learners, welcome to our session today. I'm your instructor, CPA Aringo Frederick. So in our class is a continuation of what you were doing earlier on, and this is the question that you are doing. So in that question, in our previous class, in the previous video we did the marginal, coming up with a profit and a marginal costing. So today I want us to prepare the income statement using absorption costing. So looking at that question, we want to come up with an income statement. This is a income statement. This time around you're using absorption costing method, absorption costing technique. So this is what we are looking at in our class today, using absorption costing technique, because in the previous class we did for marginal costing technique. So looking at absorption costing technique, the first thing that we mention always, we must prepare the cost statement, that is in regard to product cost statement. That is always the first thing that we should always advise that you should always be doing. So preparing your product cost statement. So looking at our product cost statement, so my product cost statement, looking at our product cost statement, in this case we are using absorption, and using absorption, if you can recall, we noted that is going to comprise of all the variable costs, variable overhead costs, and fixed production overheads costs. So in our case, identifying the variable production OHDs, and also I'm going to take the fixed production OHDs. So looking at that case, coming to our question, are we given these elements? So coming to our question, I'm having variable, I was given 3, whereas for fixed production overhead I was given 1. So determining our production cost statement, that is product cost per unit, you should be having how much? 4 shillings. So that should give us our cost per unit. This is production cost per unit. That is production cost per unit. Therefore, I should be having a figure of 4 shillings. Taking our variable production overhead 3, we add fixed production overhead as 1. So the moment you do have that one, comfortably I can come and now prepare what? Our statement. So sir, as we had mentioned earlier on, we are going to start with sales. So talk of our sales, and I'm looking for how many months. We are talking of how many months, my good students. In our question, we were given how many months? Jan, Feb, and March. So I should be having January here. So talk of January. So I'm having January. We do have our Feb here. You can take our Feb, and you can take March here. So given the 3 months, January, Feb, and March. So just like the other question that we did, I'm going to have our sales, and for sales for the month of Jan, I'm given 36,000. For the month of Feb, I'm given 42,000. And for the month of March, I'm given 48,000. So those are the number of units that you are given. So if you are looking at the month of January, I'm given 36,000. I believe you had noted that one. So I should be having the month of January. I'm going to have 36,000. We multiply by the selling price per unit. And in our case, selling price per unit, you are given a figure of how much? Selling price per unit, we were given a figure of 5 shillings. So I should be having by 5. So I'm having by 5. Feb, I should be having 42,000 by 5. March, I should be having 48,000 by 5. So same concept applies. So in such a case, how much should we be having? Talk of in the month of January, our total sales will be 36,000 by 5 to give us 180,000, to give us 180,000. Remember, for sales, it just be the same as with the marginal. It will just be the same as marginal. So 42,000 by 5 to give us 210,000, right? 48,000 by 5 to give us how much? 240,000. 240,000. So that is our sales. That is our sales. That is our sales. So the next thing to do will be to take care of what? The next thing to consider, I'm going to consider our cost of sales. So cost of sales. And this is where we should be very keen. This is where we should be very keen. This is where we should be very, very keen. So determining our cost of sales, I'm going to start with the opening inventory. Items to consider: opening inventory. Opening inventory. Then we are going to look at our production for the period. Then after that, we are going to consider what? Our closing inventories. Items to consider. Items to consider. So looking at that case, opening inventory. In the month of January, were we given any opening inventory? Look at this question. So in the month of January, I don't have any opening inventory. That is dash. So the month of January, my opening inventory, I don't have any. So I'm going to have dash. What about our production? What did we produce in the month of January? Our production in the month of January, we can see I was given how much? Production for the month of January, I was given 45,000, 36,000 Feb, and March 45,000. So that is our production. That is our production. That is our production. So how will we determine then our production cost here? The same concept that I had mentioned on marginal. If you had gone through the video very correctly or very well, I'm having a production cost per unit, which is 4. So therefore, our production in the month of Jan, I should be having number of units, which in this case we produce 45,000. I'm going to multiply by 4 to give us how much? It's going to give us a figure of 45,000 by 4. That should give me 180,000. So our production here will be 180,000. Talk of, for the month of Feb, our production was 36,000. The same case, production per unit, I'm going to take the one that we had prepared in the production cost statement by 4. Talk of the other one, the month of March, 45,000. We multiply by our production cost per unit, which is 4. So this should give me how much? 180,000, just as the same one that we had as at the beginning, or as at the in the month of February, I should be having 36,000 by 5. That should give us 36,000 by 4. 36,000 by 4. That should give us 144,000. So therefore, at this point, I should be having 144,000. So that is our production. That is our production. What about closing inventory? The same, I believe I mentioned the concept of how to determine the closing inventory in our previous video, because in this case, how to determine your closing inventory? You're going to take your production during the period. You're going to add your opening inventory during the period. Then you're going to less your sales during the period. Less sales. So that the balance should give you your closing inventory. The balance should give you closing inventory. The balance should give you closing inventory. So like our production in this case, we had 45,000. We didn't have any opening inventory, but we had a sales of 36,000. So in such a case, you notice that our units, in regard to the number of units, they should be having how much? 9,000 units. So therefore, to determine our closing inventory, I should be talking of the 9,000 by production cost per unit, the one that we had prepared under the production cost statement. Production cost statement. That is a production cost statement. So you should be having by 4. That should give us how much? That should give us 9,000 by 4 to give us 36,000. So my closing inventory value should be having 36,000. So what about cost of sales? To determine our cost of sales, therefore, should be having 180,000 plus 36,000. That should give us, that is 180,000, sorry, minus 36, because it's closing inventory, minus 36 to give us 144,000. So I'm having 144,000 here being our cost of sales. This is our cost of sales, cost of sales. So therefore, comfortably, I can come and determine our gross profit. So therefore, my gross profit in this question should be having how much? Talk of our gross profit here. Talk of our gross profit. So my gross profit, therefore, I should be talking of 180,000 being our sales minus cost of sales, which is 144. So 180 minus 144, which will give me 36,000. So this is our gross profit at this point, 36,000 in the month of Jan. What about in the month of Feb? So in this case, you should be very careful. Our closing inventory in the month of Jan, our closing inventory in the month of Jan should be our opening inventory in the month of Feb. So in this case, I should be having in the month of Feb, my opening inventory will be 9,000. We multiply by production cost per unit, which was 4, to give us the same figure, which is 36,000. What about our closing inventory? So our closing inventory should determine, in this case, our closing inventory, our production in the month of Feb, we had a production of 36,000 units being our production. Our opening inventory in this case is 9,000 units. So I'm going to have 9,000 units. Then our sales during the period, we had 42,000 units. So 42,000 units. So that should give us our closing inventory for that month of Feb. So you should be having 36,000. We add 9,000. We deduct 42,000. That should give me a closing inventory of 3,000 units. So our closing inventory, I should be having 3,000 units. So bila woga, takuja niandike hapa 3,000 units by production cost per unit, which was for the one that we had calculated here. So therefore, my closing inventory in the month of Feb, I should be having 3,000, we multiply by 4 to give me how much? 12,000. That is our closing inventory. Remember this when you are deducting. That is our closing inventory. So to determine our cost of sales, therefore, for the month of Feb, I should be having 36,000, yes. We add 144,000, yes. We deduct 12,000, correct, to give me 168,000. So the same case, our cost of sales here is 168,000. So having that case, you can comfortably come and determine our gross profit for the month of Feb to be how much? 210,000. Our sales here minus our cost of sales, which in this case we have determined it to be how much? 168,000. We should be having 42,000 being our profit. You see the way it's flowing? It should flow like that. It should flow like that. So what about in the month of March? So in the month of March, our closing inventory in the month of Feb should be our opening inventory in the month of March. So my opening inventory in the month of March, therefore I should be having 3,000 units. We multiply by 4, which gave us how much? It gave us 12,000. It gave us 12,000. So to determine our closing inventory for that period, the same concept will apply. I'll take my production during the period, which was 45,000. We add opening inventory for the period, which is 3,000. Our sales for the period was 48,000. So therefore my closing inventory, as at the end of the period, I should be having how much? I should be having 0. I should be having 0, because 45 plus 3, which is 48,000, minus 48,000 to give us dash. So in the month of March, we didn't have any closing inventory. That should be 0. So talk of our cost of sales, I'm seeing I'm having 192,000, because it's 180 plus 12,000. So therefore I can come and have our gross profit to be 240,000, which is sales, minus 102,000, which is cost of sales, to give me 48,000. So I should be having my 48,000 there being our gross profit for the said period. Being our gross profit for the said period. So that is what you're required to do, my good students. That is what you're required to do up to gross profit. Remember, we are not yet done. This is absorption costing. This is absorption costing. So if you go through our question again, to observe what you are given now. Like in this case, the beauty part, the examiner had given us the opening inventories, which we've seen how we've determined that one. Talk of closing inventory. Actually, he had also given us, we've seen how we determine that one. So the next part will be upon us to come up with, it will be upon us to prepare or to achieve our net profit. To achieve our net profit. That is what you are required to determine our net profit. So before our net profit, I know very well I'm going to consider either over or under absorption of overheads. So in this case, we are going to consider either talk of either under / over absorption of OHDs. Under or over absorption of overheads. So at this point, you should be very, very, very keen whenever you want to prepare or whenever you want to determine your under or over absorption of overheads. So this is what you are going to do. This is what you are going to do. We are going to look at our actual. We are going to talk of our actual. We are going to talk of our actual, and we are going to look at absorbed fixed OHDs. So when we're talking of actual, ideally we're looking at marginal, what we had under marginal costing, and in this case we're looking at the absorbed fixed overhead. So to have recorded under fixed under absorption. This is absorption costing technique. And what are we considering whenever I'm looking at this key element? What we are considering here, we want to consider our fixed OHDs. Production. We are looking at production, fixed overheads. This is my area of concentration. Fixed production overheads, to determine if we had either over or under absorption of overheads. So if we look at our question, let me share that question. If we look at our question here, fixed cost per unit for normal output, I was given 39,000. So kind of as if we are preparing a production cost statement, kind of as if you're preparing a production cost statement, production cost statement. That is, of course, we are looking at marginal. This is marginal. We noted that the variable under marginal, we talked of considering only the variable production overheads, and in this case I was given variable to be how much? Variable I was given only 3. But where you should be very keen with is on the aspect of fixed production overheads. Fixed production overheads. That should be our area of concentration. That should be our area of concentration. Fixed production overheads. Fixed production overheads should be our area of concentration. Should be our area of concentration. The fixed production overheads. So allow me to. So looking at that case, let us analyze it. Under marginal. Under marginal, my good students, under marginal, what did you took? 39,000, because I was given 39,000 for the month of Jan, which same applied for Feb, and which same applied for March. That is what I was given. I was given 39,000 units. So to arrive at our production overheads, fixed production overheads, we took is kind of, we had 39,000 by 1, which gave us 39,000. So I should be having 39,000, 39,000, 39,000. For marginal, it will not change. It will not change for marginal. But how about under absorption? Under absorption, I'm going to consider the units that we produced during that period. The units that we produced during that period. So like in this case, in the month of March, how many units did we produce? In the month of March, we produced 45,000 units. So I'm going to take 45,000 units by production cost per unit, which in this case, you're given how much? 1 shilling. I was given 1 shillings. This is a question. We are told that fixed cost per unit, you are given, this is fixed production cost per unit, I was given 1 shilling. So I should be having 45,000 our production times 1 to give us 45,000. The other point we produced, how many units? 36,000. So I'm having 36,000 in this month. And in this other case, in the month of March, we had 45,000. We had 45,000 being our production. So comparing our actual and absorbed. So therefore, assuming I'm deducting all these components. So deducting that, what should we be having? What should we be having? The first case, I'm having 39,000. Actual was 39,000, the one that we had set, minus 45,000, which in this case is 6,000. Which in this case is 6,000. Which in this case is 6,000. So therefore, I should be having 6,000 here. But remember, what you have absorbed is more than what we had under marginal. So therefore, this should give us what? This is over absorption. This is over absorption of overheads. That is over absorption of overheads. Over absorption of overheads. What about in this case? Our actual is 39,000 and we absorbed 36,000. So I'm having under absorption of overheads of how much? 3,000. This is form of negative, right? This is under absorption. Under absorption of overheads. Talk of for the month of March. For the month of March, we had 39 and I'm absorbing 45. So I'm also having what? Over absorption, 36,000. Or rather 6,000. This is over absorption. Over absorption of overheads. So at any given point, we mentioned at any given point I'm having under will always add. And whenever we have over, we are going to deduct. We are going to deduct. Under we notice that we are going to deduct, and over we do what? We add. So look at this question of hours. Look at this question of hours here. This was our question. That was our question. So we want to consider those elements of under and over, which you've just done them here. I've shown you how to work them out. I've shown you how to work them out. So that will just be simple, because the next thing to do, I'm going to incorporate them in our statement. Just a moment, we do that right now. So we have it here, the question, you've seen it. So incorporating our figures here, under, we've said under we are going to deduct. So under, in this case, so for the month of Jan, I'm having over absorption, meaning that we add over absorption. So I'm having over absorption 6,000 here. Under absorption, in this case, will last 3,000. Whereas for the month of March, I'm having over absorption of 6,000 we add. So remember, this concept will vary when we'll be looking at in regard to our opening inventories. So this is our production, and that's how we determine either over or under. Remember, even if you start with deducting absorption and marginal, and so long as you understand the concept, it just be the same. So after we have this, we can now comfortably come and have our figures here correctly. So this is 6,000. So here I should be having how much? 42,000. We add over. On this other case, I should be having how much? 39,000. We've deducted under, and on this other case I should be having how much? That should give us 54,000. So that is not the end. So after this case, I'm going to consider other costs incurred. Like what? Did you have any other cost incurred in this question? So looking at this case, other costs incurred, like variable and fixed other costs, we don't have. So if we could be having other costs, I could have added, say, like I could have added costs like say variable selling and distribution cost. We could have added, say, fixed selling and distribution cost, but in this case we didn't have. So therefore our net profit for the said period, our net profit, we should be talking of our net profit being 42,000 here, talk of 42,000, talk of 39,000, and talk of 54,000. That should be our net profit. 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 Just a moment. That should be our net profit. So remember, suppose you have any question, you can always ask us. You can always ask in our phone application down there under ask question button. We have an area that you can ask your question and be assisted accordingly. Be assisted accordingly. So we're just back on air right now. So as I was saying, that is what you are supposed to do in regard to that question. So unless we have any other question, we can continue in our next class handling another concept for the same. So as we say, this will be our net profit: 42,000, 39, and 54,000. That is what you are required to do. So up to that point, let us meet in the next session, whereby we are going to handle another question in relation to this, because as you've noted that our profits are not the same compared to marginal, the question that we did in our previous session. The profits are not the same. And if the profits are not the same, now you're supposed to come in and do what? The reconciliation statement. So in our next question, we'll also be looking at how to reconcile these two techniques, how to reconcile the marginal and absorption costing technique in relation to, when it comes to the income statement. I'm going to give you a formula which will assist you when it comes to that. So to that point, thank you so much, and let us meet in the next session. Thank you.